In this video, I'm going to talk about why so many floor traders struggled with the transition from pit to screen. Stay tuned. Hey traders, a very warm welcome to you. Okay, so I watched this video called Floored, and this is what it looks like here. And also I've read a couple of books from ex-floor traders. Have I got them handy? Let me see, I should have prepared them for you. This is one of them. Have I got the other one here? I haven't. The other one's called Pit to PC. Similar kind of books. But the point is, and these are guys who have been relatively successful going from the floor to the screen. But most traders can't do it. And I saw this with this movie or kind of documentary that I was watching. I thought, okay, this is interesting. Why is that the case? Now, I've never traded in the pit. However, I used to subscribe many years ago to a Squawk service where a guy would stand not actually in the pit. I think he was kind of on the tiers somewhere with a headset on. He would be watching what was going on in the pit. So all day he would kind of say it's 50, it's 20 bid, 50 offer, and he would have kind of shorthand terminology for it that took a while to get used to because when it was busy, it was busy. But he would say, okay, I've got a local trading with another local being someone in the pit who's just a trader. Oh, I've got Goldman coming in now. I've got a broker for, Merrill coming in. I can see them doing that. It would just be the eyes for the pit. Now, this was really useful, man. It was one of my massive edges for a while. It wasn't a lot of the time, it was quite dull, but when it was exciting, as in when it was busy, it was exciting as well. He could hear the volume picked up. He was saying who was coming in and selling, who was buying. A local was trying to push the market and bully the market, and it kind of gave you an idea. And by the way, this is the S&P 500 pit, just to clarify. I don't think I mentioned that. And it would give you an idea of what was going on. But it kind of got me thinking. So why are these guys who are in the pit doing so well and making many millions regularly in the pit, go to the screen and they just flop? They can't make any money. And it got me to thinking, there's two different ways that the trader's making money. There are the guys, obviously on the screen, everyone is in exactly the same boat. There's no preferential treatment going on. It's first in, first out. It's price cap, it's price time. So if you've got a better price and you put your bid in, you're going to get filled. It doesn't matter if you're better than Goldman, you're ahead of Goldman. If you're ahead of everybody else and you put a better price in, that is you. You are the best bid in the world in that exchange, and you will get the first sell that comes in if you are offering the highest price. Same with time. It's a time order. It goes in, the exchange goes in, your time goes in. The later you are into the book, the further you've got to go down the book and wait for your fill. Those are the rules. In the pit, it's a little bit different. There wasn't this issue, wasn't this thing of if you're first bidding, you're the one that gets the deal. Everyone is bidding, and very often you would get times where someone would bid, let's say in the pit it was 15, 30, 20, 15, 30, 50. Let's say this is the S&P 500. Someone could be bidding 15, 30, 30, but someone might get filled at 15, 30, 20 because he's a mate of his and he knows he's good for the deal, and he sees either one who sees him. So it was very inefficient in that way. Anyway, let me go back to the point. So the guys in the pit had a lot of edges, and also comments in the comment section below. If you're in the pit or you knew someone who's in the pit, I'd really be interested to hear your thoughts on this, whether I've got it right or whether I've got it wrong, or whether you want to add something to this. This is kind of my take on it. So you'd have a big buyer here, for example, and you've got this kind of cliched cigar smoking guy with a lot of dollars who says, hey, you know what, buy me 1,000 lots, whatever it may be. That's probably a bit much, but you get the point at 15, 30, 20, the best, worst possible price, and lower if you can. So this guy who's the trader and the broker, because that was the other thing, they had a stack of orders that come in, many multiples of these guys. They'd have, I think they called it a deck of orders beforehand, so they'd know, hey, I've got a 500 buyer here, I've got 100 buyer here, I've got 200 buyer here, I've got this and this. So they would see where the orders were in the book, and they could also trade on their own account because that was what they're allowed to do as traders. So what they would do is, let's say the market was coming down now, you'd have the market coming down to that 15, 30, 20 level here, and he knows that he's got this guy who's already given him an order to buy 1,000 at 15, 30, 20 or less. So what does he do? He can buy as many as he wants at 15, 30, 20. He can go long on his personal account here, knowing that if the market carries on pushing lower, he'll just sell those back to this guy here. He can buy 100 lots of 15, 30, 20. But if it starts going lower, he just transfers those futures contracts to him with no risk, with just a transactional risk. However, if it pops up off that and goes up to 15, 35 or something, he says, thanks very much, I'll take my 5 points profit. So he can play that game all day long. And he can do that many times, knowing that there are many multiples of buyers or many multiples of sellers at different levels. He sees the levels and he's not doing anything wrong there. This guy's still getting the order he wants. He said, I want to buy at 15, 30, 20. The fact that the market may well have broken through that doesn't really make any difference, because that guy just says, well, I'll give you those 500 at 15, 30, 20. That was what you wanted. You've got them. Very much the customer was getting a lot of, screwed a lot here. And often, a story of a friend of mine actually traded the wrong contract. He put an order in for S&P futures, and it was, I don't know how he did this anyway. He put it in electronically, but it actually went through to the pit, and he was like, why is it taking so long to fill you out? And the broker said, well, it's gone to the pit, you're waiting for the order to come back. And it's like, oh my gosh, I didn't really meant to do that. Anyway, the point is, when that order goes through, if it's a market order, you're going to get whatever fill they fancy giving you, and you can bet that they are going to take the cream of that. Now, obviously, they're not going to shaft you too much, and if you're a good customer, they've got to weigh up, taking some profit from you and having you as a customer to come back all the time. But if someone just random puts in a market buy order, they are going to make sure that their buddy over there who is offering, let's say they see the 15, 30, 50 offer. Let's say they also see, their buddy also offering 15, 32, say, that's a 3, by the way. They're going to say, yeah, buy it from him. And he's going to make a quick 1.5 points, because he can then flip it straight away to the other guy. And the customer's going to get filled at 15.32. Maybe the market goes through 15.32, but in between time, someone's made a quick 1.5 points on that, however many size you've got. He's made some money. His buddy's happy. He knows that he's going to return the favor sometimes. The customer's not that happy, but doesn't seem to be too bothered, because ultimately, he's got filled reasonably where he expected to get filled, and that's the way it worked. Now, obviously, this will come undone when the market would trade. That would be the high tick of the day, and you'd be the guy who got the high tick of the day because that trader gave you a fill that really wasn't there. And often trades would get busted, and there's all sorts of stuff going on because it's all written down on cards. There's a lot of communication issues from time to time, and people saying, hey, I didn't trade with you, no, I didn't say yes, and there's a lot of trust involved. So it was a bit of a kind of, you had to know people and who was who and who was what, and know who you're dealing with and when and why. But that generally was why the transition was difficult for them, because when they're going back to the electronic market, there's none of that. You don't have that underlying edge in there where you've got the backstop of these orders. You've got these orders coming in where you can make a little bit of cream in between the order and between filling the order and putting it back to the customer. You are literally gone from the middleman to the customer. You are now the customer who sees what everyone else sees, the price coming through, time and sales, whatever you're using, the chart, and you're making a decision based on that, as opposed to the underlying edge that you were given as an authorized trader in the pit. Anyway, that's my take on it, guys. Thoughts in the comment section below. If you like the video, give it a thumbs up. And if you haven't yet, consider subscribing somewhere down here, probably on a mobile device, here or here. I don't know where it is, but consider doing so if you haven't, for more videos from myself and other traders on this channel. Anyway, guys, take care, keep the risk managed. I shall see you in the next one. Goodbye.